when we are talking about the things, okay, when we are taking into consideration, see, you will have what? You will have 15 questions, section A, section B, 3 questions will be there, section C, 2 questions. Both questions are compulsory and must be attempted. Okay, fine. Now, slowly and slowly you will understand how the things are very clear. Okay, one, this is section A. Mostly section A will be theoretical one, section B will be calculations. Okay, section C you will have ratio analysis, financial statements, is it, cash flow statement, what we have done, or group accounts. Okay, why? Now what we are doing, one by one we will do. Okay, only I will give you option. The process will be like this. We will discuss and I will give you an option. If your option is right, fine. If there is any option plus or minus, I am here to explain you. Now when you are doing MCQ, is it right? Whenever you are doing MCQ, keep it in mind. You have A, B, C, D. Okay, you have this option. The rule, the technique, I will not say rule, the technique is, some questions we know this is not the answer. Elimination, is that we have to work out with elimination. Once we are eliminating, then we can say yes, within these two options there will be answer. This is the most important choice, is that we will have two close answers. Okay, two close answers, we have to select one. There we have to be very clear about the knowledge what we have learned. Fine, this is where it will work. One by one. Which of the following should be capitalized initial carrying amount of an item of plant? This is with respect to chapter 2. Is it IAS 16, property, plant and equipment. Which of the following capitalized, which amount should be capitalized? Is it right? Which amount? Now, cost of, is that cost of transportation of the plant? You are taking the machinery, you are purchasing the machinery, you are getting the machinery from to your place. Is that? This is your transportation cost. If we are having the transportation cost, what will happen? The cost will increase. Only training cost should not be there. Okay, keep it in mind. Training cost is not to be included. Cost of installation. Is it? Cost of installation. New power supply required to operate the plant. You are installing some new power supply. Cost. Long-term cost. Is it? Long-term cost. It is dedicated to the plant. Is it? It is dedicated to the plant. Fine. Okay. Fine. Cost of 3-year maintenance. Maintenance is not a capital expenditure. Maintenance is a operating expenditure.
Expenses.
Okay. Operating expenses should not be capitalized. Is that? Should not be capitalized. Training cost should never be capitalized. Maintenance cost and training cost should never be capitalized. Okay, these two. Answer is what?
1 and 2.
1 and 2. If you have any disagreement, you can question me anytime. These rules are same. Okay, rules are going to be same. Next, while if I am fast, tell me I am fast. Okay, once it is over, I will send you the same thing. When a parent is evaluating the assets of subsidiary, this is in terms of a group accounts. We have not done, but I will explain you. Okay, I will. We have done intangible assets. Okay, we have done intangible assets. Certain intangible assets can be recognized separately from the goodwill. Okay, we can recognize separately, even though they have not been recognized in their own financial statements. Keep it in mind. What we have to do? We have to think about IAS 38. Basic definitions, criteria. The first pages of every chapter is important. Which of the following is an example of an intangible asset? Okay, intangible asset which be recognized separately from goodwill when preparing consolidation. Now, what happens in the, I will again tell you in terms of intangible assets. Intangible assets, is it right? Oh, if it is, you have to buy, purchase, then only it will be recognized. Is that if you are self-generating, is it right? It is self-generated, internally generated. Sorry, okay, internally generated. It is not self-generated. It is internally generated, not recognized. Is that internally generated? Or it is purchased. It is. Now, intangible assets. You will have two things. One is the research, and one is the development. I am giving you a brief revision about what we have done. Research should be expensed. Is it right? It is in the profit and loss account. Development is going to be capitalized.
Nice.
It is in the statement of financial position, SFP. Okay. Now, a research project which is subsidiary has corrected. What is the requirement? They are asking. This is the requirement. Which of the following is an example of intangible asset? Should be recognized separately from goodwill. A new research project which the subsidiary has correctly expensed to profit and loss account, but the directors of the parent have reliably assessed to have a substantial fair value. Again, when you are talking about the fair value, you have to think about IFRS 13. Is that IFRS 13? Now, a new project which has subsidiary subsidiary has the project. Okay, subsidiary has, it is like this. Is that you will have the parent company? Is it right? You will have the subsidiary company. Okay, what happens? Parent is going to purchase the subsidiary. Now, how it has to be recognized separately. A new project which a subsidiary has correctly expensed. Is right? Here they have used a statement of here they are using profit and loss account. Is it a statement of profit and loss account, SPL? Is it a, they have used that? But the directors of the parent reliably, the intangible asset has to be reliably measured. Is that reliably measured and to have a substantial value? Okay, that is one of the criteria of IAS 38 intangible asset. A global advertising campaign which was concluded in the previous financial year, from which benefits are expected to flow in the future. See what they are talking about, intangible asset. A global advertising campaign, it is expenses. Is it which was concluded? Is it which can be concluded? See, advertising campaign is not a capital. Is it? It is not a cannot be capitalized. Is that cannot be capitalized? Fine, it cannot be capitalized. Okay. Next, a contingent asset. Is it right? A contingent asset of the subsidiary for which the parent believes a flow of again contingent assets. Contingent asset means may or may not be. Is that may or may not be? Again, it cannot be. We are not sure. Is that cannot be recognized? Okay. Forget about capitalization. It cannot be recognized. A customer list which the directors are unable to value. Customer list is internally generated. I am giving you a complete understanding about each and every point I will explain, and almost the complete chapter will be covered. You will have all the doubts will be cleared with respect to one question. If you are doing one MCQ question, it means we are doing 4 questions. With reasons, okay, with reasons. This is advertising campaign cannot be capitalized, contingent asset cannot be recognized, okay, one cannot be capitalized, one cannot be recognized. And this is a internal generated funds. The answer is what? Tell me. A new research project which the subsidiary has correctly expensed to profit and loss account. Expensed, okay, cut to the profit but the directors of parent have reliably. See, this is the word, is it right? This is the word which matters a lot, okay, reliable. Whenever you are measuring, it should be reliable, okay. Reliable we assessed with respect to fair value. You are assessing, is it right? You are assessing the value of that intangible asset in a reliable manner and correctly expense. Are you clear about this? Where are you people?
Here, doctor.
Is it okay?
Yeah, doctor.
If I'm telling you wrong, I will give you the reasons why it is wrong also. Okay, that's very important. Now, can I go to the next one?
Yeah.
On October 1st, is it right? 1/1/10/2004, they acquired a plant under lease, okay, under 5-year lease agreement. Under the terms of agreement, they are immediately paying how much? They are immediately paying 2 million is payable.
2 million.
And the present value of lease, always we have to take present value.
Present value.
Okay, always we have to take present value. Rentals are payable in each year for how much? 30th September, at the end of the each year, okay. The agreement has an implicit cost of 5%. The agreement has an implicit cost of how much? 5%. Fine. What they are asking you, what is the current liability? Is that we have done, if you remember rightly, okay? We have done year, we have done year, opening balance, is it right? Interest at the rate of 5%, is it right? How much you are going to pay and what is the closing balance?
Yeah.
Is it right? First, they always, what they have said, this is happening when this is happening, the is payable has been calculated how much? Has been calculated as 25,272. They have started on the first 10, but the year ending is how much? Year ending is 30th September 2005. Is it 30th September 2005? Now, how many years? 5 years. Okay. How many years it is there? It is for 5 years. But they are asking us what? They are asking us what is the current liability or the lease plan in the financial statement 30th September 2005. If they are asking for 30th September 2005, we have to do it for 2005 and 2006. Whatever the difference between 2005 and 2006, that difference is going to be identified as a current liability. How much is the balance? 25, is it right? 25,272. Is it? What is the interest you will get? Tell me fast. At the rate of 5%. 25 to 72 times 5%.
1,263,600.
1,263,600.
600.
Payment, how much they are paying every year? Annual rentals will be how much? 6 million.
6 million.
Is it right? Annual rentals is also 6 PM. See, 1, 2, 1, 2, 3, 4.
2, 4, 4.
5 is equal to 2 plus 3 minus 4. How much you will get? 20.
205.
How
yeah.
much?
2,053,5,600.
Again, you have to take for, we have to know, want to current liability, is it right? 2006. 205,35600 times how much? 5%. How much you will get?
1,026,780.
10.
68,780.
Check,
1,026,780.
check again. 205,35600 times 5%.
1,026,780.
205,356 times 5%. How much? 10?
05, yeah, 1,026,780.
6 million. How much you'll get balance?
Uh, 155,62,380.
155,6.
62,380 minus 205.
What is the difference here?
Difference 4,973,220.
This is current liability. This is the amount they are paying immediately next year. Is it right? Next 12 months after reporting date. Is it? This is the amount they will pay after first year. Okay. Next 12 months. Are you clear about this?
Yeah.
Next. Financial statements represents transactions in words and numbers. To be useful, financial information must represent faithfully these transactions, how they are reported. Identify by selecting relevant box in the table whether the statement regarding faithful representation is true or false. Charging the rental payments for an item of plant to the statement of profit and loss, where the rental agreement meets criteria of a lease and no exemptions are available. Are you understanding what they are asking?
No, I'm reading again.
Charging the rental payments, okay, rental payment for the item of plant to the statement of profit and loss account. Is it right? Where the rental agreement meets the lease. Have you ever saw in your plant, in your statement of profit and loss account, any lease payments? Have you ever done in statement of profit and loss account? have you shown any time anything like lease payments?
No.
No. That is what they are asking. That is what? Where the rental agreement is with the lease. It is not rent. It is with the lease. No recognition available. Is there? No recognition, exemptions are there. Rental agreement, can we show rental agreement? Understand that. Can we show rental agreement, charging the rental agreement to statement of profit and loss account? Can we do that?
No.
No. It is a false. Is it? Including a convertible loan note in equity on the basis of holders likely to choose equity option on conversion. See, this is with respect to IFRS 16. Is it? This is with respect to IFRS 9, financial instruments. Is that? Including a convertible loan note in equity on the basis that holders are likely to choose. Option is there, they are not choosing. Likely, in future it will happen. But now you can include into equity. In future, is it right? In future it happens. In future they have the option. Is it? In future they have the option to convert to what? To convert to equity. In future. But right now you can show it in equity?
No.
No. And this is the, see, questions are very, you have to understand how it will work. Is it right? Including a convertible loan note in equity. What is the basis that it will likely to choose on conversion? Is it? We cannot, unless until it is converted, we cannot show in equity. Okay? In future it may happen, but now we are not going to show it. Next. Treating redeemable preference shares as a part of equity in the financial position. We have done this. It is there in the preference shares. If you take the IFRS 9,
40.
redeemable, which one we have to take? Redeemable or irredeemable? Redeemable is a financial liability. Is it? Redeemable is a financial, means you are paying it back after some time. Is it? You are paying it back after some time. Redeemable, treating redeemable shares as a part of equity. Irredeemable can be treated. Okay? Irredeemable. Is it? But redeemable cannot be treated. Redeemable. Read this again when you are doing the revision. Read this again. Redeemable is going to be what? Redeemable is going to be a financial liability. De-recognizing factored trade receivables sold without recourse to the seller. Any idea about this?
No, doctor.
You have an idea about with recourse and without recourse? We have done this.
We have done, yeah.
With recourse and without recourse.
Yeah.
With recourse means if it is not going to be collected, you can return it back to the, Without recourse, if it is not collected, It is the responsibility of the factor. Is it? It is the responsibility of the factor. Is it? De-recognizing factor trade receivables. Is that without de-recognizing factor trade receivables without recourse? Is that without recourse means it is the responsibility, it is the responsibility of the factor. Is that you are selling it off? Is that, see, assume, take an example like this. Is that, take an example like this. You have 100,000 receivables. You are with recourse means if it is not recovered, they will return you back. Without recourse means you are selling it. Is it right? If you are selling it, if it is not recovered, is it right? It is not recovered. If it is not recovered, it is whose responsibility? It is the responsibility of the factor. Once you have sold the factors, is that once you have sold the factors from your balance sheet, you will remove it. The risk is transferred here. Is that the risk is transferred? Is that the risk is transferred? Here the risk is not transferred. If risk is transferred, you will de-recognize. Why you will keep in your balance sheet? It's not that you have sold it. You got your money. Is that without recourse? Fine, without recourse. Are you clear about the explanation?
Yeah.
Is that it is true or false?
It's a true.
You are selling the factors. Once you have sold it without recourse, you have to remove it from the. You have to remove it from your financial statement. Now, on October 1st, can I start this one?
Yeah.
Is it? They have commenced drilling from oil under sea. This is required to dismantle the drilling machine at the end of 5 years. What is the estimated cost? Estimated. This is 1/10/2004. This is 30th September 2009. Is it? This is 30th September 2009. What is it? How much is the dismantling cost? Dismantling cost is 30 million.
30 million.
Is it right? And what is the cost of capital? Cost of capital is 8% for 5 years. What is the present value? Present value is 0.68. Tell me, easy one, easy one. Dismantling cost. Whenever dismantling cost is there, whenever dismantling cost is there, this dismantling cost you have to convert into present value. Is it? You have to convert it into present value. They gave you, is it right? How much they gave you? 30 million. Is it right? They gave you 30 million. 30 million. They gave you the present value. Is it right? 0.68. How much you will get? Calculate.
Yeah, 204000. Answer is number 3.
Pardon?
204000.
What they are asking you very clearly, understand the things. Identify the provision Kalatra has to make when, it has to make when 2005.
2020. Yeah.
Is it right? 2005. This is where, this is 110/2004. They have to make a provision. When they have to make a provision, they have to make a provision on 30 of after 1 year. After 1 year. How much you are getting here? Here how much you are getting? 204000. Anything we have to do on this?
We have to for 2 years.
For 1 year.
1 year. 24 to 25. 1 year.
Is it 2004 to 2005? What we have to do?
Divide into how many years? 5 into 1.
Think. Think. Think very clearly. Think. This is the amount at the beginning. Okay, this is the amount at the beginning. They want the amount where they want amount now. How much is the rate of interest they are asking? Where is the rate of interest they have put it?
8%.
8%. Okay. First you have to convert into present value. This is the present value. Okay. You have to calculate interest. At what rate? 1.08. Is it 1 into 1.0, or you calculate interest and you can add the interest. Simply is 1 plus R. Okay. How much you will get? 20,000 into 2400 into 1.08.
22032.
22032. Answer is
2.
straight away we cannot say that we will put 20,000. See, 2400 is, now I will tell you, 2400 is the present value. Is it? And this is with interest. With interest when it is on 39/2005. Is it okay?
Yeah.
Fine. Yes. Hussein and Sumaya. Hussein, Sumaya, is it okay?
Yes, okay, doctor.
Okay? Now, what they say? When a single entity make purchase or sale in foreign currency, we have done foreign currency in somewhere in chapter 13. Okay, chapter 13. It will be necessary to translate the transactions into functional currency before the transactions included in financial records. Fine, that's good. In accordance with IAS 21, which of the foreign currency exchange rate may be used to translate the foreign currency purchases and sales? Which rate we will use? We will see We are talking about purchases and sales. Okay, your purchases and sales. The rate at which existed on the day the purchase or sale took place. Is that when it has been purchased or sale took place? Is that? See, there are two things. Either you tell me, you guess, no problem. You guess. I'm here to support you. Read. Take your time.
Mean the exchange rate?
Yes. Which exchange rate we will take? We will not take beginning at the beginning. Never. Understand point? Outrightly. We will not take the rate which is at the end also. Because purchases and sale will done throughout the year. Is it? Throughout the year. When you are taking throughout the year, either it will be on that date or on average basis. Is it right? It is taken on that particular date or it is done on an average basis. Are you clear about this?
Yes.
It will not be done at the beginning. You will not take beginning or end. Okay, opening balance, beginning, closing balance, end. But you are talking throughout the year. The answer is
1 and 3.
1 and 3. Next. On October 1st, they have had 2.5 million of equity share capital. 1/10/2004. How much is the equity capital? 2.5.
Can you move that paper, doctor? It's not moving.
It's not moving?
No.
Now?
Blank.
What about Hussein?
No. Now it's okay.
It's okay?
Yeah, now it's okay.
It's okay.
Fine. Okay? Now.
Yeah.
They have said how many? 2.5 million. No new shares were issued during the year, but on that day there was outstanding options are there, which will be dilutive effect, equivalent of issuing how many shares? 1.2 million shares. Is that 1 point? This they are talking in terms of which one? IAS 33 EPS. Is it right? Now, what is the diluted earning per share for the year ended 31st December? Diluted earning per share. Okay. How much is the profits? Profits 2.5 million. This is opening. Is it right? This is opening. Okay. We should also have a closing. Is it right? We should have also closing. If there is no closing, we will take closing as there is no, they said, no new issue shares were issued during the year. Is it 30th September 2005? How much is there? 2.5 million also. This is the closing. Fine. They have a dilutive effect of how many shares? 1.2 million. Is it? They have added. Is it right? They have added how many shares? 1.2 2 million shares. Is that added? Profit after tax is how much? 155. They are asking EPS. How many shares are there total now? Total shares will be how much?
6.2.
Huh? How you will
5
add?
plus
This is
1
opening,
point.
this is closing, my dear.
Closing we can.
This is
Closing and
2.5 and this is
plus
1.2. How many shares are there?
3.7.
3.7 million shares.
2.5.
Is it right?
Yeah.
Is it fine?
Yes, that.
How much you have to take? How much you have to take?
Uh, 1550
1550 divided by,
by 3.7
check again.
number of shares. Total shares plus
Total shares will be how much?
2.5 plus 3.7.
2.5 is the opening. Okay, 2.5 is the opening. Closing is how much? 2.5. Is it right? Now, they have issued October 2004, 2.5. Okay, 2.5 shares of 50 cents each in issue. 2.5 million. This is dollar, my dear. How many share equity share capital? 50 means 1 minute. 1 minute. This is 2.5. Number of shares will be how much? This is 2.5. Okay, 2.5 million divided by how much? Value of each share is how much? 0.5. $2.5 million. Okay, 2.5 divided by 0.5. Number of shares will be how much?
Five.
Is it right? How many shares are there? 5 million shares. Is that 5 million shares? Okay. Understand my getting my point?
Yeah.
This is 2.5 dollars. Is it right? 2.5 million. And this is each share is how much? Each share is 0.5 cents. How many are there? 5 million shares. Okay, 5 million shares. How many shares they have added? They have added 1.2 million shares. Total will be how much? Total will be 6.2 million shares. EPS is nothing but 1.55. Okay, this is dollar, this is million divided by 6.2 million shares. How much?
170.
Huh?
1055 divided by 6.2. 0.25. 25.
Is it okay?
Yes.
Answer is
This one 1.55 million, which is 155.
yes. 1.55 million. Or you can do like this also, nothing will happen. 155,000 divided by, this is put dollar, okay? Divided by 6,200.
Alright. Yeah.
Fine?
Yes.
Next. I will explain you this, okay? Not, it is not difficult, okay? How much is there? Fork, okay? Fork is owned, how much? 80%. Fork is 80% of spoon, okay? Spoon will be how much? Spoon will be 20%. Several years ago, how much is there? They have the goodwill. Little bit I am not, we have not covered. Little goodwill. Is that goodwill is how much? Goodwill is 1674. On acquisition, okay? On acquisition means it is purchased. Is that? It is purchased. There is no impairment is there, okay? There is no impairment is there. Is it? They have disposed of, they have sold entire investment. Is that? They have sold entire investment. How much they have sold? They have sold for how much? They have sold it for how much? Sales proceeds is how much? Sales proceeds is 5580. Is that? Sales proceed is 5580. Is it? Now, how much is the cost? This is the entire cost of investment is this much, okay? The rule say that we will, is it? Entire cost of investment is this much. Now, before disposal, before they have sold it, what is the statement of parent? This is the parent company, fork. Is that? Parent is fork. Included is, there something which has been included. What is the amount included? There is some amount related to goodwill, okay? Excluding goodwill. Is it? There is some amount, carrying amount of net assets, okay? Carrying amount of net assets. Carrying amount of net assets. We have to add it, okay? How much is there? 4464. They have something is there. Carrying amount of the non-controlling interest is nothing but the subsidiary. Is it? Is the how much is the subsidiary? The subsidiary is how much? Is it? The subsidiary carrying amount is how much? Carrying amount is how much? Carrying amount is of subsidiary is how much? One. Carrying amount of subsidy. Was it 1 minute? Is it? See, carrying amount of, 1 minute, carrying amount of net assets is how much? Goodwill is how much? 4464. We have taken this, okay? Now, anything related to the parent, is that they say excluding goodwill. Actually, we have to include goodwill. How much is the goodwill amount they have mentioned here?
1674.
1674. Is that? Add goodwill. 1674. See, this is the, when you are purchasing it, when you are parent is purchasing the subsidiary, how much you have paid, how much, what is the value of the net assets, because you are paying, you will get all the net assets of the subsidiary. You will get the goodwill also. You have paid for goodwill on acquisition is almost 1/7. Now from this, what you will do, you will deduct the share of the subsidiary. The share of the subsidiary is called as non-controlling interest. NCI. How much is the non-controlling interest? Non-controlling interest is 900. Is it? Non-controlling interest is how much? 900. Is it? Non-controlling interest is how much? 900. Sale, is it? This we have to deduct it from where? This amount we have to deduct it from the sale proceeds. Is that to acquire the subsidiary? How much we have paid? I will put this on the here. I will put instead of this. Is that how much you have paid? You have paid 5580. Is that you have paid how much? 5580. On 5580,
Yeah.
what are the things you have done? You have the carrying amount, the assets value is 4460, the goodwill value is 1674, and the share of NCI is how much? Share of the subsidiary is how much? Now, 4464 plus 1674 minus 900. How much you will get?
5238.
5238. Difference is how much?
$342.
With zeros, okay? 342 with
Yeah.
zeros.
0, yeah.
This is positive, okay? This is positive, is it right? This is the positive.
Yeah.
I will repeat this again, okay? Wherever it is needed, it will take little bit more practice. It will be very specific for our understanding. Okay?
Yeah.
Next. This is also we have not covered, okay? I am telling you in advance, okay? Which is not covered, I will tell you in detail. When you are doing consolidated financial statements of the companies within the group, if the consolidated are presented on the basis that the companies within the group are treated as a single economic entity. See, previously you will have the parent and you will have the subsidiary, okay? You will have the parent and you will have the subsidiary. Parent financial statements will be different, subsidiary financial statements will be different. But once you have acquired, parent has acquired a purchase subsidiary, you will have one consolidated statement. You have one consolidated. Automatically what will happen? The subsidiary financial statements will be merged. Is that with the parent statement? What they are asking us, which two of the following requirements in preparing the consolidated financial statements? Which two of the following? All subsidiaries must adopt accounting palette. There is no rule that what parent is doing, subsidiary also do the same thing. Parent will be, see what happens if you see the thing. If you take the mergers, is it right? If you take the mergers, acquisitions, all those things, is it? Parent will be in the construction company. Is it? Parent will be in the construction company. The subsidiary will be in the tourism company. Is it? The subsidiary will be in the tourism company. There is no hard and fast rule that what subsidiary must. There is no must. Understand? But always there is a flexibility. Okay? Always there is a flexibility. In accounting there is no condition that you have to follow. Everyone will have their own assumptions. Is it right? You will have the own assumptions, you will have the own limitations. So there is nothing like you have to follow. Must is not there. Okay? Subsidiary activities which are substantially different to the activities of the member should not be consolidated. Is that there is nothing like there is no condition you can buy anything. No, you are doing the business in automobile. Is that Toyota can buy some? See what happens. You see the Twitter. Is it that you see the Tesla? Tesla buy Twitter. Is it right? Tesla bought Twitter. There is no hard and fast rule that Tesla should not buy Twitter. Is that something which is not related you can buy? Is it right? There is nothing that the subsidiaries with activities substantially different to the activities of the member should not be consolidated. No rule is there. Is that? No rule is there. We want two conditions. The first two conditions are not within our purview. But we will not say that next two are there. We will understand what are the next two. All entity financial statement in the group normally prepared to the same accounting period. Is that? Or that's why you are prepared. When you are preparing, you will not prepare on 31st March, one you will not prepare on 31st December. They will not be like that. If you are preparing the financial statements, you will prepare on a one date. All group financial statements. Is that you will prepare on one date. Understand with reason. Unrealized profit within the group must be eliminated. See what happens, see the thing. Before there is a merger, is it right? Parent is different, subsidiary is different. Parent will have sales, is it right? And subsidiary will have the purchases. Parent will sell, subsidiary will purchase. Or in other words, subsidiary will sell, is it right? Subsidiary will sell and parent will purchase. Is it? This will happen. Now what happens? Definitely when you are selling it before, you will add profit. But once it is consolidated, okay, once it is consolidated, once you are purchasing the thing, we will say that there is nothing, then only will be one company will be there. There will not be two companies, okay, there will be only one company. In one company, what will happen? You will not have any profit. Is it? You will not have any profit. There is no purchase and sale practically. It is only one company that exists. Okay, it is only one company that exists. If one company is existing, definitely there is no concept of profit or losses. If there is any profits, it is called as a unrealized profits. Is that unrealized? Unrealized profit, if there is any unrealized profit, it has to be eliminated. Is that? It has to be removed. Okay, because why we are removing? The reason is there is no one entity, okay, only one company. How we can make it profit and losses? Are you clear about this?
Yes, doctor.
Fine. Next.
Yeah.
This is with respect to consolidations. Just wait, okay? We will just wait. We will do what we have done. Then we'll come to this, okay? Otherwise, you people will get confused very easily, okay? Just I will cover this separately, okay? I will cover this separately. This one is that I will put this one and this one. It is not difficult. Only thing is, if I tell you in the middle, you will get some confusion, okay? You will get some confusion. See the things. I will take 11 number, okay? I will take question number 11. Fine? Can I start this one?
Yes, doctor.
Quartile company is a jewelry retail business which can be assumed to be highly seasonal. Highly seasonal. For the year ended 30th September 2005, Quartile assessed its operating performance by comparing the selected accounting ratios with those of business sector average as provided by the agency. Means what you are doing, you are comparing with the company with the industry. Is that you are comparing the ratios of the company with the industry standards. Fine. Now, assume that the business sector used by the agency is meaningful representation of quartile company business. Is that it talks about the meaningful, means whatever the it is similar to the industry, and the company is almost similar in nature. Fine? They are talking about the things. Which two of the following circumstances may invalidate is not right to comparison? Is that which of the means which are not the when you should compare, when we should not compare? What are the things when we have to compare, when we should not compare? In which situation we can compare two things, okay? We cannot say that everywhere we can compare and everywhere we cannot compare, okay? Now, if that is the case, what they say, which two of the following, quartile with those of the, in the current year, quartile has experienced significant rising cost for its purchases. Is that is it? Is it significant rising cost? Means what happened in the current year? Quartile has experienced significant, means the company only exclusively the quartile company cost has been increased. Okay, cost has been increased for purchases. Fine. The sector average are compiled from companies whose year ends are between 1st July and 30th September. The sector average, okay? The sector average means the sector average figures are compiled from companies whose year ends are between, fine. They are saying that it is who is going to end July, August and September. Who is ending on July 1st to September 30th. Some standard is there. Quartile does not revalue its properties but is aware that other entities sector do. See, if there is any inconsistency between two, is that between quartile and the industry, any inconsistency, in anything not matching, then we should not take. There should be some consistency, because what happens, rule says that if there is a consistency, then only there will be a comparison. If there is no consistency, there is no comparison. Fine. Quartile does not value. Okay. The first one is, in the current year, quartile has experienced significant rising cost for its purchases. Second one, the sector average are compiled from two companies whose year ends. Fine. There is some consistency that there is a year end is going to be between 1st July and 30th September. Fine. During the year, the last one, during the year, quartile discovered an error relating to inventory count. The error was correctly accounted for the financial statements for the current year ending 30th September. Now you tell me any one. 3 people are there. You can select any one. Which two are not consistent?
Three.
Tell me. 3.
Yeah. Does not evaluate its property, but it's aware the other entities in the sector.
Fine.
Do.
Next. Good. Anything? It's affecting one. Second one, the sector compiled from whose year end? The sector is C. This is valid. Okay, this is valid because they are saying that we are taking those companies whose closing period will end from 1st July to 2005 to
September.
30th September. Consistency is there. Okay, consistency. Last point also, they have discovered the error, but the error was correctly accounted in the financial year. This is also valid. Is it? This is also valid. Whereas in the current year, this company cost has significantly increased for its purchases. The company cost has increased. Is it right? The company cost has increased. Maybe because of some reason. The industry has not increased. If the company cost is increases and industry cost is not increasing, then they will not have any balance. If there is no balance, then it is a invalid assumptions. Is it clear to you?
Yeah.
Okay, it is a invalid assumptions. Fine. Next. Can I go to the next one?
Yeah, doctor.
Which of the following criticisms does not apply to historical cost financial statements? You should know what is the historical cost financial. Historical during the period of rising prices. Is it? Historical is which will have on the rising prices. Now, which of the following criticisms, is it right? Which of the following criticism does not apply? Means there is some positivity is there. They are difficult to verify because transaction could happen many years ago. Historical, is it right? Historical means it is a history. Is it? It happens many years ago. It is a criticism. Is that they are difficult to verify because transactions could have happened many years. It is true. Is it? They are difficult. It is true. It is one of the limitation. They contain mixed values. Some are at current values and some are out of date values. Is it? They contain mixed values. Okay. Some items are of current values and some are out of date values. Is it true or not?
False.
They contain mixed values. Okay, some are current values, some are past values. Some are current values and some are what? Some are past values. Okay? Is it right? They are mixed values. Some of them are in the current values, some are in the past values. Is it true or not?
This will apply in the historical cost, right?
Yes.
But here the question is it does not.
Yeah, that's why it's na. Which of the following does not apply? I will put like this. I will not put true or false. I will use apply or don't apply. Okay?
Yeah.
I will put apply or do not apply. That will be more easy to understand.
Yes, better.
Is right? Apply or do not apply. Now, coming to this, is it now you tell me. They are difficult to verify. They are difficult to verify because transactions could have happened many years ago.
Yeah, apply.
They are difficult to verify because transactions could have happened many years ago. See, historical cost. Historical cost. What happens in 2015 You have purchased your car in 2015 at 20,000 reals. It will be same. It will be same. You cannot go and say that I have purchased it now the value is 25,000. I purchase. I can change my value. I can change my value. You cannot do that. Okay, you cannot. We cannot change the value as such. Does not apply. Okay, does not apply. Little bit thinking. Okay, little bit we have to be very careful. They contain mixed values. They contain mixed values. Some are current values and some are outdated values. Is it true? They contain mixed values. Historical financial statements. Historical cost financial statements. You are, see, I will put like this. You are purchasing. You are purchasing on 1/4. You are purchasing on 1/9. You are purchasing on 30th of October. Is it right? You are, some will have current values. Some will have out of date values. Yes or no?
Yes.
Yes or no?
Yes, doctor.
Yes. Okay. Yes. Fine. Any doubt is asked. This apply. They understate assets and overstate profits. Understate assets. You are buying an asset, okay? You are buying an asset. Assume you are talking about a car. You are saying that I have purchased it on 1st, okay? You are saying that what will happen? Your expenses. Take the expenses here. It will be more reasonable for us to understand. Is that you are talking in terms of expenses. What happens when you are talking about the expenses? You are spending 1/4. You spend 250. 1/6 you are spending 300. Is it right? 1/6 you are spending 300. 1/9 you are spending 500. Your expenses are increasing. Is it right? Your expenses are increasing. When your expenses are increasing, what will happen? Definitely your profits will decrease.
Decrease. Yeah.
Okay, profits will decrease. Unevenly is decreasing. Is that if your profits are decreasing, what will happen? Your equity will also decreases. If your equity is decreasing, your assets will also decreases. Getting my point? Your assets will also decreases. Getting my point? Your assets will also decrease. You see, yesterday I paid 100. Today I will pay 120. Is that I will pay 120. Tomorrow I will pay less. One day I will pay more. Okay? What will happen? Definitely they will understate the assets and they'll overstate the profits. Is it right?
Profit.
It is also apply. Understand, and any doubt is there, stop me. They overstate gearing in the statement of financial position. Is that they overstate gearing in the statement of what is the gearing, what is the ratio of, what is the formula for gearing ratio? Yes, last class we have done. Debt divided by debt plus equity. Is that debt divided by debt plus equity? Now what happens? They say that they overstate. They overstate gearing in the statement. Gearing means here the component is what when you are taking any loans, is it right? What will happen? The rule says that it will have a concept of what? It will have a concept of present value. Is that it will have a concept of present value. When you are doing this, the value of the money will decrease. Is that the value of the money will decrease? When the value of money decreasing, definitely what will happen? Assume. Take an example. Take an example. You are talking 10,000 is the debt. 10,000 is the debt plus equity is going to be assume 12,000. Is it? How much is there? I will put like this. I will not put. I will not put 12,000. I will put 30,000 so that it will be easy for you to understand. How much is there? 10 divided by 40. It will come to how much? 0.25. Historical, is that historical cost? Historical, now you see the thing. This has been happened in 2022, 2023. Is that 2023? Equity will increase. Is that equity will increase because of what? Equity will increase because of profits. Okay. Whereas debt will remain same. Okay. Debt will remain same. Subject to repayment. Okay. Subject to repayment. Now you see the things. Assume you have paid the debt. Now the debt is 9,000. Is it 9,000? But what happens? The equity has been increased. Is it? The equity has been increased to with profits. It has been increased to how much? 31,000. Now 9,000 divided by 31,000. 9,000 divided by 40,000.
Yes.
Is it? 9,000. Your equity is increasing. You are one side you are repaying your debt. Another side your equity is increasing. 9,000 divided by 40. It comes to how much?
Uh, 0.225.
Is that there will be a change? Is that you are what happening? There is a overstatement of gearing in the financial position. Means what they want to say that historical cost, is it right? Historical cost will have will make the if you take the historical cost, whatever the amount has been reflected, that amount has to be continued. Because of that, it will have impact on the gearing ratio. Are you clear about this?
Yeah, doctor.
Little bit.
Yeah.
It is not difficult. It is easy. Is it? It is easy to verify. Okay, there is always till now there is no substitute. Okay, till now there is no substitute to the historical cost. Whatever you have the financial statements, is it right? This does not apply. Because what happens, see that why does not apply? I will give the reasons also. Okay, why it does not apply means what happens in it is not difficult. What we are doing? We are taking 2021, 2022, 2023. Is it? We are taking 2021, 22, 23. Consistently we are taking. We are not going to change. Is it that there is no difficulty? We are following this. And we following this, and we will follow all the years. Is there any substitute for this? Till now there is no substitute. You take your bank they say that it is easy to follow. Is it? Bank will ask last 5 years financial statements. because they find it is very easy to make a comparison. We can come across many difficulties. We say that prices are changing. We say that there is a inflation. But if you take all the things into consideration, still nobody is there to solve this issue. So we don't have a good alternative. Okay, we don't have a good alternative for doing this. Is it? That is the reason the first one does not apply, the second, third and fourth it applies. Is it okay?
Yeah.
They are asking us trade receivables collection period. What is the formula for this? Any idea?
Let's divide account receivable.
The following information yes, accounts receivables. The following taken and calculated from financial statement. Cash cycle. Is it? Cash cycle is how much? Means what is the cash? If you take cash cycle, is it right? It is inventory plus receivables minus payables. Is it right? Inventory days, receivable days minus. How much is the cash cycle? Cash cycle is 70. Is it right? Inventory turnover is how much? 6 times. Is that inventory turnover is how much? 6 times. How many days will be there? Inventory turnover is 6 times. Okay, 1 minute. Inventory turnover is 6 times. Payables is how much? Payables is 230. Purchases is 2 million. And cost of sales is how much? Cost of sales is 1.8. Is right? Cost of sales is 1.8. How much is the payables? 2.3. Is it? 2.3. Okay, 2.3. Yes. Fine. Inventory days. Okay, inventory days. How much they say? Turnover is how much? 6 times. Is it right?
6 times.
Number of days in a year divided by number of days in a year divided by inventory turnover ratio. How much inventory turnover ratio?
70.
No, inventory turnover ratio is how much? $365 divided by 6 times. How much you will get?
60.
60 days. Okay, 60 days. Next, payables will be how much? We got how much? See, 70 is equal to 60. We don't have receivables. Okay, we don't have receivables. We will calculate payables. Payables is what? What is the formula for payables? What is the formula for payables? Payables, is it? Payables, how much is the payables? Payables is 230 divided by, is it? Payables divided by, how much is the purchases? Credit purchases. Credit purchases, okay? Credit purchases times 365. How much is it? Times 365. Payables are how much? 230. Credit purchase is how much? 2 million. Times 365. How much you will get?
41, almost 42.
Almost
42.
almost 42 days. Fine. Now, can you tell me how much is receivables this from this? Can you tell me if receivables are on this side? If you get the receivables on this side, 60, okay, receivables will become minus, okay, minus receivables, left hand side to right hand side, okay, 60, is it? 60 minus 70 minus 42, is it right? Receivables minus receivables is equal to how much? 60 minus 70 minus 60. 60 minus 70 minus 42.
52.
How much?
52.
52. Minus 52. Is it right?
Yeah.
Is it right? Minus 52.
Yeah.
You cancel minus, okay? You cancel minus this side, minus. Receivables will be how much? 52, or maybe we have, is it right?
51. No?
Is it okay with this?
Yes, doctor.
Just give 1 minute, give space to this. We will work, okay? Fine. We should have 15 questions, I don't know. Okay. Fine.